SPMO crushed SCHG by 24 points. Better returns with less pain and a faster bounce back. That's dominance. SPMO crushed it with a 148% 5-year return, while SCHG delivered 100%. That's a massive performance difference. SPMO's beating SCHG decisively, 24% versus 16% over the past year, and it's consistent across all time frames. SPMO finished 48 percentage points ahead over 5 years, same market track. But what's under the hood makes all the difference in this race. SPMO's winning the risk-adjusted game with a sharp ratio of 1.4 versus SCHG's 1.1 over 3 years. SPMO's crushing it on downside protection. 1.9 versus 1.5 means better returns when markets get ugly. Think of risk-adjusted returns like a lever. SPMO multiplies your force. You're getting better outcomes without pushing proportionally harder on the risk side. SPMO's downside protection shines here, weathering a 20% drop while SCHG tumbled 23% during market stress. SPMO bounced back in just 39 days. SCHG needed 83. That's more than twice as fast recovering. SPMO's 23% drawdown looks mild compared to SCHG's brutal 35% crash. That's significantly better downside protection here. SCHG bounced back 3 months faster than SPMO, proving growth stocks can recover quicker from major downturns. Here's the roller coaster truth. SCHG plunges 35%, while SPMO drops just 23. Bigger falls mean you'll need way steeper climbs to recover. SPMO's lighter crash and quicker bounce back means you'll spend less time underwater when volatility hits hard. SCHG puts 44% in technology. That's nearly half your portfolio riding on one sector's performance. SPMO spreads the risk better. 32% in tech is hefty, but way less concentrated than SCHG's 44%. SPMO is betting nearly 3 times heavier on financials than SCHG, 20% versus just 7% allocation. SCHG loads up nearly half its portfolio in tech, while SPMO serves a more balanced slice with heavier financials. 2 different investment pizzas entirely. SPMO's dominating across the board. Better returns, superior risk metrics, and stronger drawdown protection. SCHG only managed to bounce back faster in that 5-year window. SCHG spreads your money across nearly twice as many companies, offering broader diversification than SPMO's concentrated approach. SCHG puts 62% into megacaps. That's serious concentration in the market's biggest, most dominant companies. SPMO keeps just 39% in megacaps, giving mid and large caps serious room to power your returns. SCHG's loading 62% into megacap giants, while SPMO spreads the wealth. It's like choosing between a few big baskets or many smaller ones. SCHG's expense ratio is just 4 basis points. That's incredibly cheap, even by today's low-cost standards. SPMO's expense ratio sits at 0.13%, triple SCHG's cost, though still competitive by broader industry standards. SPMO's cheaper valuation at 23.5 suggests you're paying less per dollar of earnings compared to SCHG's 28.2. SPMO's 5.0 price-to-book beats SCHG's 7.5. You're getting more asset value for every dollar you invest here. So which one's right for you? SPMO, if you're balancing growth and caution, SCHG for long-term stability. SPMO's the scenic route, better returns, smoother ride. SCHG's your interstate option with rock-bottom costs. Choose what fits your timeline and how much bumps you'll tolerate. The legal stuff. Basically, do your own homework before investing. We're just showing you data here. If you want more weekly breakdowns like this one, hit that subscribe button and we'll keep them coming.